Welcome to the Deep Dive, your shortcut to being well-informed. Today, we're taking a deep dive into Applied Digital Corporation's fiscal fourth quarter 2025 earnings call.
Yeah, and this one felt different, not just the usual numbers update.
Exactly. It felt like a real declaration, a massive strategic pivot they're making.
Laying out a whole new future for the company in high-performance computing. HPC.
So our mission today is to sort of sift through all the numbers, the strategy talk, and figure out what it actually means for Applied Digital and, well, for you listening.
Absolutely, because this call really marked, I think, a significant inflection point. They're repositioning, moving away strategically from that older crypto hosting business.
Right, the legacy stuff.
And really planting a flag in this booming world of AI and HPC infrastructure. It's quite the transformation story.
And the market seemed to buy it, didn't it? That reaction was something else.
It really was.
Yeah.
Suggests investors are, definitely buying into this new narrative.
Okay, so let's get straight to the headlines then. Q4 fiscal 25. What did the numbers actually say?
All right. So GAAP EPS, that's the standard accounting earnings per share, came in at negative $0.12.
Which was right in line with what people expected, yeah.
Pretty much spot on. But, and this is where it gets interesting, the non-GAAP adjusted EPS, that was negative $0.03.
Okay, wait. Negative 3 cents versus expectations of negative 14 cents.
Exactly. A significant beat versus the Zacks consensus estimate. Big difference there.
Wow, okay. What about revenue?
Revenue, well, it came in at $38 million. That did miss the consensus, which was around $42.1 million.
So about a $4 million miss.
Yeah, roughly. But you got to put it in context. Even with that miss, it was still up 41% compared to the same quarter last year.
41% year-over-year growth is still pretty solid, even with a miss.
Definitely signals some underlying growth momentum. Other numbers to note, adjusted EBITDA was $1 million. Adjusted net loss, $7.6 million. They had about $121 million in cash and total debt around $688 million.
Right. So despite that revenue miss, which, let's be honest, often spooks the market, the stock just took off.
It soared, yeah.
So investors clearly weren't sweating that miss. They were looking past it, focusing on something bigger.
Absolutely. I think what you're seeing is a fundamental re-rating of the company.
A re-rating. We've explained that a bit.
Well, investors are shifting their focus less about the historical crypto performance, which can be volatile, and much more about the de-risking and the long-term visibility that comes with this AI pivot.
So moving from maybe a commodity view to more of a utility AI infrastructure view.
Precisely. It changes the whole valuation multiple, the perceived risk. That's what drove the stock, I think.
Okay, that makes a lot of sense.
Yeah.
So let's really dig into this strategic pivot then, because it sounds like the absolute core of the story.
It is.
They're moving away from crypto hosting, going hard into these long-duration AI high-performance computing leases, calling them AI factories.
Yeah, and it's not just talk. The scale of the commitment is what's really striking. During the quarter, they signed these huge, transformative 15-year lease deals.
With CoreWeave, right, the big AI hyperscaler.
Exactly. For 250 megawatts of IT load at their campus in Ellendale, North Dakota.
Which they're now calling Polaris Forge 1.
That's the one. And 250 megawatts, I mean, that's a serious amount of power dedicated just to AI.
And the momentum just kept going after the quarter ended.
It did. Post-quarter, CoreWeave exercised an option for another 150 megawatts.
Wow.
In a third building at the same campus, Polaris Forge 1.
So that brings the total just with CoreWeave up to 400 megawatts?
400 megawatts, fully contracted. It's massive.
That's an incredible validation just from one major customer.
It really is. And if you look at the bigger picture, those deals alone, they're expected to generate something like $11 billion in contracted revenue.
$11 billion over the 15 years.
Over the 15-year terms. That gives them incredible long-term revenue visibility.
Yep.
And like we said, that's what the market loved. And to really underline this focus, they also reclassified their old cloud services business as discontinued operations, sort of drawing a line in the sand.
Okay, clear signal. Let's talk about Polaris Forge 1 itself. Designed to be scalable, potential up to 1 gigawatt, you said.
Yeah, a full gigawatt potential, a huge hub.
So what are the timelines? When do these megawatts actually start firing up and generating that revenue?
Okay, so the first building, that's 100 megawatts, is targeted to be up and running in calendar Q4 of 2025, so end of next year.
Got it.
Then the second facility, 150 megawatts, is scheduled for mid-2026.
Okay.
And the third one, the other 150 megawatts, is planned for the first half of 2027.
So a phased rollout over the next couple of years.
Exactly. Staggered milestones. Smart way to manage it, brings revenue online steadily.
Now, they talked a lot about speed, a repeatable build process, cutting construction time from maybe 24 months down to just 12 or 14. How are they doing that? What's the trick?
Yeah, that's crucial for staying ahead. They highlighted this innovative cooling system. It's a closed-loop, direct-to-chip liquid cooling design.
Okay, so not just blowing cold air around, liquid right on the chips.
Right. Much more efficient for these incredibly dense AI workloads. And that efficiency lets them target a really impressive PUE, power usage effectiveness.
PUE.
That's
Lower is better, right? Closer to 1.0.
Exactly. 1.0 is perfect efficiency, all power to compute. They're targeting about 1.18.
That's really good for this kind of scale.
Very good. And importantly, they're aiming for near zero water consumption with this design.
That's a huge environmental point and probably a cost one, too.
Absolutely. A significant differentiator.
And they kept mentioning the Dakota advantage. What's that all about?
Ah, yes, the Dakota advantage. It's basically about leveraging the location.
How so?
Well, the Dakotas have abundant low-cost energy. Some of it is even stranded power, generated power that's hard to get to major cities.
Okay, cheaper power.
Cheaper power, plus the climate gives them over 200 days of free natural cooling.
So less need to run expensive cooling systems for a good chunk of the year.
Precisely. They actually put a number on it, said a 100-megawatt customer could save up to $2.7 billion over 30 years compared to billing in other regions.
$2.7 billion. That's a massive saving.
It's huge. So you combine that with their efficient cooling design, and the goal is a really competitive total cost of ownership.
Makes sense why they're prioritizing North Dakota then, even while looking elsewhere.
Yeah, they mentioned exploring other sites in the MYSO grid, even down south, but North Dakota seems to be the focus for now because of these economics.
Okay, building all this, even with advantages, takes serious cash. Gigawatt scale AI factories? How are they funding it?
Good question. They said they're actively working with financing partners right now to finalize the project financing specifically for Polaris Forge 1.
Okay. Any timeline on that?
They expect it within the next 4 to 10 weeks. So pretty soon.
And they also raised money recently.
Yeah, post-quarter, they boosted their liquidity, raised about $269 million through an ATM, selling shares into the market, and also issuing some Series G preferred stock.
So topping up the coffers, and the financing environment seems surprisingly good for them.
It does, actually. Management mentioned a pretty constructive backdrop for project finance, especially when you have investment-grade tenants like CoreWeave.
Because the lender has confidence in the tenant paying the lease.
Exactly. They mentioned indicative rates in the high 2% to low 4% range.
Wow, that's low for project finance these days.
It is. And loan-to-cost ratios around 70%. It suggests lenders are pretty confident in these hyperscaler-backed projects right now.
But is that sustainable, those kinds of rates, as everyone rushes to build AI capacity?
That's the million-dollar question, isn't it? Right now, the demand from credit-worthy tenants like CoreWeave makes these projects attractive to lenders. How long those specific rates hold up? Market conditions can change. But the fundamental demand is definitely there.
Okay, so CoreWeave is the anchor tenant. A massive one. But they hinted at others, more hyperscalers in the pipeline.
They did. They specifically said they've completed the whole diligence and onboarding process with 2 other investment-grade North American hyperscalers.
Okay, so getting them approved and ready to potential sign deals.
Right. And they acknowledged it's a complex, long process. They also said they're in advanced negotiations with one of those 2 for another large capacity campus.
So Polaris Forge 1 might just be the beginning.
Looks that way. They really emphasized their experience here in navigating land deals, power agreements, specialized construction as a competitive advantage, a barrier to entry for others.
Got it. So looking ahead near term, what did they guide for the next quarter?
They expect revenue to ramp up significantly sequentially, starting the quarter ending this August.
Okay, so the current quarter, why the jump?
It's mainly due to the technical fit-out of that first Polaris Forge 1 building.
Ah, so getting the inside ready for CoreWeave. Racks, cooling, power.
Exactly. That fit-out work generates revenue, includes a small margin. It'll mostly be recognized this quarter and the next one, ending November.
And then the actual lease revenue starts kicking in once it's fully operational.
That's right. The fit-out revenue comes first, then the higher margin recurring lease payments begin.
Okay. And the big picture, the long-term vision they laid out.
Pretty ambitious. They're aiming to generate $1 billion in annual net operating income, NOI.
$1 billion a year.
Within the next 3 to 5 years. And just think, Those CoreWeave leases alone, they said, get them roughly halfway there on an annual basis.
So that goal seems plausible based on the CoreWeave deal alone.
Plausible, yeah. And they also expect to break ground on at least one more campus, maybe even two, before the end of this year.
Wow. Aggressive expansion plans. So let's connect the dots for listeners. What does this all mean for you? The market reaction, that 31% stock jump, it tells a story.
It absolutely does. Despite that revenue miss, investors look straight past it. They clearly prioritize the long-term contracted revenue from CoreWeave.
That $11 billion number.
And the whole AI capacity pipeline, it's a fundamental shift in how the street values APLD.
And the analysts seem to agree.
Oh, yeah. Wall Street jumped on board. Needham, Lake Street, H.C. Wainwright, all raised price targets, kept their buy ratings, targets going up to $20.
Strong conviction there.
Definitely. And it lines up with the macro picture, right? The AI data center build out is just exploding. Hyperscaler spending is through the roof.
And Applied Digital is trying to position itself right in the middle of that hurricane.
Exactly. Locking in these long-term utility scale AI contracts, moving definitively away from volatile crypto towards what looks like more stable, high-demand AI infrastructure.
Okay, time for our This Is Not Financial Advice segment. Let's put on our hypothetical, super aggressive investment committee hats. Based purely on this call, what's an outrageous but maybe plausible trade idea?
All right. Well, thinking about CEO Wes Cummins specifically saying he prefers the full stack model.
Meaning they deliver the whole AI factory ready to go, not just the empty building with power, the powered shell.
Exactly. And considering these huge, long-term, fully leased deals like CoreWeave, here's the hypothetical trade. A highly leveraged long position in APLD.
Okay, going big on Applied Digital, paired with
A short position on a different publicly traded data center company that focuses primarily on just providing the powered shell.
Interesting. So long the full stack provider, short the powered shell provider. What's the rationale?
The bet is that APLD's specific model, their efficient design, the fast build times, the Dakota advantage, will let them command better economics and a higher valuation from these big hyperscalers.
You're betting the market increasingly wants the whole package, the ready-to-run AI factory, not just the empty box.
Precisely. It's a conviction play that this full-stack, purpose-built AI factory model is the winner over the next, say, 12 to 18 months as this AI build-out really ramps up. Outrageous, maybe, but based on their strategy, plausible.
So wrapping up this deep dive, Applied Digital's Q4 call wasn't just ticking the quarterly box. It felt like a major statement.
Yeah, a clear declaration of their future, aiming to be a dominant player in AI and HPC infrastructure.
The CoreWeave deals are obviously huge anchors. The fast build-outs, the strategic focus. It seems like they've set a clear course.
A course for potentially significant long-term growth, yeah. And the market's reaction suggests strong confidence, at least for now, that they can actually execute.
It's quite a journey, isn't it? From crypto hosting to potentially multi-billion-dollar AI factory deals.
It's a fascinating transformation. Definitely one to watch closely.
And just a reminder, everything we've discussed today is for informational purposes only. It is definitely not financial advice.
Please do your own research, your own due diligence before making any investment decisions.
But hopefully, this gave you a good sense of what happened on that call. Think about what stood out to you. Was it the scale of the CoreWeave deal? The technology? The risks? Lots to consider there.